After 2 years of pessimism, there is now widespread optimism about the U.S. economy, with many believing in continued strong growth and high asset prices. This optimism is further fueled by the new administration's promises and stimulus measures suggesting that American exceptionalism might persist. I'm Michael Drozd, Chief Investment Officer for LaSalle Street. This is A View from the Street. Stay tuned to learn why investors may want to balance optimism with caution in 2025. Wall Street is anticipating a 17% earnings growth for 2025, with PE ratios near record highs. Credit spreads are at their lows, or at least since before the global financial crisis, and short-term rates appear to be indicating the end of rate cuts, with real yields near cyclical highs as well. Investor confidence is high, with almost everything except bonds rising. Despite this optimism, there are signs of cooling. Data on production, housing, labor, and capital investment show some slowdown, while inflation remains above the Fed's 2% target and potentially moving higher. Recent increases in long-term interest rates and a strong US dollar also suggest tighter financial conditions are ahead. Currently, markets are pricing in strong economic momentum supported by pro-growth and disinflationary policies. This optimism requires economic support or actual policy changes to remain sustainable. While reducing regulations, providing incentives for small businesses, and tax cuts are all positive, achieving new policy goals is uncertain and often slower than what markets need to continue on. Even if the U.S. economy meets these high expectations, most financial assets have already priced in this scenario. Given the current market conditions and potential outcomes, a more balanced investment approach in 2025 is advisable, especially after consecutive years of double-digit returns on the S&P 500. While the belief that significant monetary, fiscal, and regulatory changes are always beneficial for asset markets is bold, history has shown otherwise. While risk assets may benefit from the modestly favorable backdrop starting 2025, navigating these changes may prove to be more challenging during the year. The value of the US dollar is crucial for global economic stability. A strong US dollar can slow global growth, especially outside the US, as foreign debtors need more dollars to service debt and purchase commodities, all priced in US dollars. This often leads to selling US dollar assets, increasing bond yields, and adding uncertainty to the US bond market. In 2025, monetary and fiscal authorities will need to address these challenges. As we enter 2025, we maintain a balanced view, considering both potential risks and opportunities. Within global equities, we favor US equities over international developed and emerging market equities. And within the US, investors may want to reduce cyclical exposure and increase allocations to quality companies with strong balance sheets and high free cash flow, ultimately less sensitive to Fed policy rates. And while the US dollar remains strong and Chinese fiscal and monetary policy remains uncertain, it may be wise to also reduce emerging markets exposure. Although US-China trade policies may support growth if a deal is reached in the future. Within fixed income, we favor short maturity US Treasuries over corporates and high yield credit, as the path for inflation is still tilted to the upside. In conclusion, although I remain optimistic for the future of this country, given the current market conditions and uncertainty around the potential outcomes, a more balanced approach is advisable for 2025. Thank you for watching, and be sure to tune in to our next market update.